Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to the latest edition of Carson's Facts versus Feelings with Ryan and Sonu. We have a very, very special one. Sonu, this is episode 42, the mid-year outlook. Before we even talk about all that stuff, middle of the year, pretty incredible. What did you do on July 4th, first off, and where is the year going is my second question to you.
We're recording this soon after July 4th, but it feels
Yep.
like ages away.
Yeah.
It's just weird. I don't know. Is it weird for you that July 4th was in the middle of the week and, it completely, I don't want to say ruins. It's like, where am I for the rest of the week, right? So, but no, July 4th was great. Did some barbecue, grill, all of that. Spent some time outdoors at the beach as well. So Chicago, we do have beaches, but it's right next to Lake Michigan. So it's a freshwater beach. It's not a saltwater beach. We did that.
I did see the NASCAR race was in town also, right? Did you get a chance to check that out? Through the streets of Chicago, I believe, correct?
Through the streets of pouring Chicago. It was raining. So here's the thing. I thought, so they did a few laps and I thought they called it off, but turns out they ran the race. I wasn't there, but it was just fun to see some of the clips and especially through literally the streets of Chicago, downtown Chicago. If any of you listeners are familiar with downtown Chicago, Millennium Park, all of that, that's where the race was, right? Nearby. And here, get this, Ryan, an Australian won the race. I never know they were Australian. I mean, no offense to anyone listening to this, any NASCAR fans. I just didn't know there was an Australian favorite in the NASCAR series. But
we do get the breakdowns of who listens to this very podcast. And I know there's like two people. I think it's like two of them. There's two people who listen from Australia. So thank you for them. A majority of them obviously are from the United States and Canada. But yeah, so
what did you do?
We went to a friend's house and we had some rain also. Hung out, but my boys and I were so excited to watch Joey Chestnut win another hot dog eating contest. Similar. The rain was coming. You see all over Twitter, they said it was canceled. Then all of a sudden my boys around, Dad, it's on. It's on. We watched Joey Chestnut, but my opinion of the greatest American athlete of all time. I know that's questionable, but hey, he never loses. He always wins, and he chants USA. So that was pretty cool for July 4th, I thought. So congrats, Joey Chestnut, once again. Well, Sonu, again, let's dive in. There's a reason people are listening to the 42nd episode of Carson's Facts versus Feelings, our mid-year outlook. We're going to talk about exactly that, kind of where we just were, where we see things going. We're going to talk about some of the biggest surprises and kind of a review of the first 6 months. And then we're going to break it down, right? Where we see stocks going the second half of this year, where we see the economy and the Fed potentially going the second half of this year, looking at bonds as well, then finishing it up with some potential concerns, worries, something that maybe could mess up kind of some of the views that we just laid out there. So again, first things first, I'll set it up. Stocks had one of their best, if you look at the S&P, second best start to a year. This, what is it called? This millennium? Is that what it's called? What's since 2000? This century. Century. It's a century. I'll get there, guys. This century. Only 2019 was better. Nasdaq up close to approximately 30%. Nasdaq 100 large cap up almost 40% for the year. Just like everybody predicted it, right?
Speaking of predictions, right?
Yeah. So, what was your biggest surprise, Sonu? This the first half of this year. Let's do a little review for 5 minutes or so, and then we'll get into kind of the meat. What was your biggest surprise this year so far, though?
Wow, that's a good question. I'm trying to think about, looking back, what was the biggest surprise? I think it had to be how the run the Nasdaq went on. I mean, it's not like we were bearish, right? Goodness, we expected stocks to do 12 to 15% this year.
Exactly.
And the S&P 500 is up 17%, including dividends, right? You can't discount that. But we were kind of there, except we didn't think it will happen in 6 months. But no, this is going to be a positive year, right? Everything you've done, all the work you've done and shared over the last, 8 months really of us doing
Mhm.
9 months of us doing the podcast. So I think the Nasdaq going on that big run, and especially in May, uh, NVIDIA. Remember, NVIDIA came out that big
Oh, yeah.
earnings report, and then it jumped, what, I don't know, 24, 25% after that. I mean, I think that's safe to say was a big surprise for me. I mean, we talked about AI and all of that, but with
Mhm.
all, it's hard to time these things. Like, yeah, AI, is it going to work this year? Is it going to be for 2 years down the line, or is it a decade down the line, right? Then NVIDIA comes out and boom, everyone's so excited about it.
Yeah, you're right. Let's hope it takes a while because I like doing this podcast. We don't need computer Ryan and computer Sonu doing this podcast.
No.
We need the real
No.
thing here. I mean, clearly that's a surprise. I don't know if it's a surprise or maybe a pleasant surprise. In March, when we had some scary headlines, we did see the stock market sell off on the regional bank concerns. You know what happened, everybody? Bonds did well. Okay, they zigged when stocks zagged. Let's not forget last year, 2022, where long-term treasuries down close to 30%. The ag was down 11%. The stock market, S&P down almost 20, approximately. They went down a lot last year. But we finally saw that diversification from bonds that I was pleasantly surprised to see. Because, again, it's like we've mentioned before, we came into last year one of the very few shops that were saying the world wasn't about to end. I mean, literally, it felt like everyone was saying new lows were coming, a recession is here or right around the corner. The great macro work that you do all the time said, no, that's not true. The recession, at least, is right around the corner. You said, likely not. I saw some positive things out there, just that negative sentiment. If anything good can happen, you surprise the masses, and that is surely what happened, I think, so far. But you know what? That's what was in the past. Let's get into where we see things happening. Again, we came into the year overweight equities. We do remain overweight equities still. But let's talk about stocks, Sonu. So if our range, the Carson team, was between 12 and 15% for the full year. I mean, that was, again, one of the more bullish outlooks. Yes. It sounds like, oh, you're above it now. Where do you think, when things are all dust off that crystal ball, where do you think stocks will be at the end of this year on a total return basis, you think?
Well, and then look, just for all of you listening, Ryan and me, we talk about this so long, and so stocks are up 17% through June 30th.
Yeah, I'll just jump in. They kept going up in June. Every day they kept going up in June. I was like, we got to up it again. We got to up it again. A 6.5% jump in June kind of threw a wrench in things a little bit. Yeah.
And just to give you all a sense of, how the sausage is made behind the scenes, right? So we had a 12 to 15% outlook. And as a team, we are talking through, okay, what do we do with this now? Because if we keep it at 12 to 15%, the market's up 17. Are we being bearish now? I mean, that didn't make any sense given your views, my views, and basically what the team is seeing. So we have to up it. And the question is, how much higher do we go, right? From 12 to 15, right? Do we go to 16 to 17? Well, the market's already up 17, right? Or do we go above 20? And this is where some really cool research you did came in handy, right? So, should we give it away? Yeah. We think stocks will do 21 to 25% for, 2023 overall. So we still think there's some upside left, and the possibility of new highs between 21 to 25% will get us pretty close to the new highs, all-time highs, if not higher even. So there we are.
And when you look at what we wrote in our outlook 6 months ago, literally the first sentence we talked about, the potential for a robust, I believe we used the word robust stock gains, maybe even up to all-time highs with some good news. We said that 6 months ago when nobody was saying it. Now all-time highs are not all that far away. I mean, just your median last 6 months, Sonu, every year since 1950, the median year gains about 5%. Okay, the second half of the year. Right. That put us right about there. But when you're up big, and by big, I should say up at least 10% or more, like we were this year, the returns get even better. When you're down the year before, the returns get even better. The likelihood that this upward bias.
So if you're down the year before, and the first 6 months is, like you said, more than 10%, then the next 6 months are median of 10%,
about 12%. I think about 12%. About 12%. Yeah,
wow.
I think 11.9. Those next 6 months, and just if you're up 10%, okay, and at the middle of the year, the next 6 months are up a median 10%, double, right? The 5% median for those final 6 months. So again, it's kind of one of the is what it is, and that was just one factor. I mean, I send out tweets. People say, "Well, you can't just look at just this." Believe me, we don't. But I think it put context around things when you have various advanced decline lines strengthening. You have consumer consumer, what do I say? Consumer discretionary breaking out relative to consumer staples on an equal weight basis to a yearly high. Credit spreads remain fairly calm. The credit markets aren't freaking out. Yes, the inverted yield curve is there, but we've said for 8 months now, look what the credit spreads and credit markets are doing. They're not worried yet. There just really are some positives. Just the idea of June. We loved what happened in June because we had that great payroll number on June 3rd, and then a broadening out. It wasn't just tech, it wasn't just communication. Small caps did really well. Industrials closed at an all-time high on a monthly basis. That doesn't sound bearish to me. Some of these other areas did well, not just those big leaders. I mean, Sonu, let's talk globally for a second. So we do like the U.S. still. We just said we think some potential there. Do you think there's any potential for, we saw a lot, how do I word this? We saw a lot of strength to start the year from developed international, specifically Europe, kind of tailed off. Japan's been in a world of its own with strength. What do you see from developed international?
So we are overweight equities, and we are continuing to be overweight equities. We still like them, which is why we've upgraded our forecast 21-25%. This is for U.S. stocks, right? I should know. And that's because of solid momentum. We've been talking about, that, for a few weeks, if not months now. And the U.S. economy is resilient too, right? Now, globally, international let's take developed markets. We're talking about things like Japan, UK, Switzerland, Germany, France, all of these countries, right? They were doing actually collectively better than the S&P 500 through mid-May, somewhere around there. And then over the last 6 weeks, U.S. stocks have just taken off, right? I mean, and that gets to what you were just talking about. Industrials did well. Small caps did well. I mean, we've gotten good, positive economic news as well. And yes, we'll talk about the Fed, but the signs of the Fed's close to being done, right? Maybe 25, 50 basis points. We'll get to that, right? So I think that's been positive, and U.S. stocks have once again overtaken international. But I think international developed the international developed market economies, I think, are getting to that more normal stage of recovery, I think, similar to what we're seeing in the U.S. The only, I think, thing going against them is the fact that inflation's still much higher in a lot of these countries, right? Especially you take Europe, for example, whether it's the UK, Germany, France, places like that. Inflation's higher, which means what the central bank there, whether it's the ECB, the European Central Bank, or the Bank of England, they're still raising rates. They're still worried about inflation. Whereas here, we are seeing inflation come down a lot, right? So that's been a big push for our own forecast a bit at the beginning of the year and even right now, right? I think that's a good tailwind for the US, but it's still a headwind for international developed markets. And then you take emerging markets, places like China especially, it's goodness, that's second biggest economy in the world. And, it's not quite the second biggest market in a sense, but still it's a massive economy, right? So we all have to worry about China or care about what happens in China, right? So beginning of the year, I think things are a lot more positive because the reopening push, all of that, China was resurgent in a way. That's died down a little bit, right? Because usually I think a lot of people are expecting the government there to put a lot more stimulus into the economy and boost up the industrial supply side sectors. But that's not really happened, right? Which is not to say, look, they'll still grow maybe 5 to 6%, 5.5%. Let's just call it that. I think a lot of people were like hoping for more like 6.5%, 7% maybe, but I don't think that's happening. 5.5% is still good, but overall EM is growing below trend, I would say, and that's why we are underweight emerging market equities right now.
Yeah, and we came into this year underweight emerging market equities, and they have underperformed by a wide margin. I was going to make a joke about China 5%, 6%, 7%. We don't really trust their data anyway, so it doesn't. I don't know anyway. And I was thinking also, you talk about biggest surprises. I'm going to get personal for a second. I'm a Cincinnati Reds fan. They've been horrible forever. The Reds are like in first place playing amazing baseball. So maybe that's a bigger surprise than anything else out there. If you've watched the Reds the last couple of years, how horrible they've been. All right, so let's talk. Let's wrap this up on equities. We like equities. We like the United States here. We like the cyclical value areas to spread out. Let's talk about small caps for a second, because we came into this year overweight small caps. Everything was working great until March. The regional bank crisis. A lot of those regional banks were small cap, mid cap names. They went away. So that really hurt. But we saw a pretty good size bounce in June in small and mid caps. Talk to me about that group, why we are overweight there, and why we still think there's a chance for a catch-up trade, from smalls and mids second half of this year.
And two things. One is obviously momentum. We talk about that a lot. But even the economy, right? Look, if the economy is not going into a recession, you think, and right now we think the economy is growing around trend, if not maybe slightly higher even. We're definitely in a much better place than we were even 6 months ago. And 6 months ago, we didn't think we'd be going into a recession, right?
Right.
And things have the outlook has only gotten better. So I think that just makes the sense, makes the case for small cap, those more cyclical parts of the economy, right? But they're talking small cap stocks, mid cap stocks, smaller companies, industrials, home builders. Look at home builders too. They're a very cyclical group of stocks there that have done well this year because and that's where a real nice connection between what's happening on the ground in the economy versus what's happening in the markets. The two have gone together really well.
Mm-hmm. Yeah, and that's maybe another surprise, hard versus soft data, but we'll talk about that next when we talk about the economy. I think that's kind of what I'm looking at the clock here. We probably need to move forward, but we came into this year overweight equities. In March, we saw some weakness, obviously, on the regional bank issues. We did add a little bit of equity exposure in late March. We talked about that on this very podcast in our Carson House View models that Sonu and myself and the team run. So, we're putting our money where our mouth is. It's been a great year. We've had some pretty good calls relative to a lot of other places, but we still think stocks can do fairly well here. I'll just add a quick little disclaimer, though. August, September, October historically are not great for stocks. The third quarter is usually your weakest quarter after the run we've had. Maybe there's a little bit of a break here. Not the end of the world. Perfectly normal. We'd still expect a pretty strong fourth quarter, though, which is what you tend to see, especially on years that are having a good year at the midpoint like this year. All right, so the next thing, let's talk. Yeah, go ahead.
Speaking of midpoint of the year, right? So I got this question. This is from somebody who listens to a podcast, likes a podcast a lot. And so he was how long have you and Ryan been working together? Right. And I was like, he thought I'd say something like 5 or 6 years or something. But Ryan, how long have you been working together?
Well, it's 42 podcasts, I think, is the answer. 42 weeks, I guess. No, I mean, I started Carson Group exactly like a year ago, I think, right about now. I think July 12th was technically my first day. But right about a year, and it's been fun. I joke, I know what you're going to say before you say it. You probably know what I'm going to say before I say it. We're like an old married couple at this point, which is a good thing. But yeah, no, it's true. 42 podcasts in and having a blast, and can't wait to do number 400, 500, whatever. Keep it rolling.
I had to check myself because I was like, has it only been a year? It feels like much longer, but it's been an amazing year. So
yeah, I was gonna say it felt really short. You're saying it feels longer. I don't know, man. I don't know. Exactly. In some ways, it feels like yesterday, and some it does feel like a while. But we've had a lot. I mean, remember, and if you missed last week's podcast, we had Jessica Golson on our team, or from our team, join us on the podcast, talking more about kind of the different things that our investment research team are doing. She helps lead our investment research team, leads our platform, and just some really cool stuff that we're doing to help the industry and help advisors out there, help our partners. So if you're an advisor in the industry and you're looking around and you're not happy where you are, definitely check that out and listen, because I think we got some pretty good stuff happening over here at Carson Group. And if you want to join up, we'd love to. I'd love to chat with you. All right, so Sonu, let's go to the economy and the Fed. I'll set it up and hand it over to you. Yep. You, again, I think our friends at RenMac, maybe a couple other places, there weren't many that said, listen, we're going to avoid a recession this year. The economy's on better footing than you think. Why did you say that 6 months ago, and can it continue?
It's a lonely call to make in a way, right? Because if you think about last year, what was the biggest headwind? Obviously, it was inflation. But because inflation was a headwind, the Fed became a really aggressive factor there, right? And downside factor for markets and the economy too. And the first sector that gets hit, when the Fed starts hiking rates, is housing. Housing activity crashed last year, right? And usually when housing activity crashes, like, okay, that's a sign of recession to come. But what was pushing against that? Well, the household, the American consumer, right? And the labor market has been strong. I think our first sign of that was really, you remember that, speaking of surprises, this is a surprise even for, somebody who thought the economy could avoid a recession. You remember the January payroll report?
Yeah.
It was
550,000. They revised it down a tad, but not much. Yeah.
Much. It was like our somebody we work with closely, Joey Guidry, he put the picture up on the blog about this cat going like, oh my God. And like that's still my reaction when I think about that payroll report. I think that just reset everyone's expectations. And that was like a turning point there. Everybody's like, wait a minute, the economy is really strong.
Yeah.
And I think it gets back to employment, right? Even we got the SVB crisis, the banking crisis. That didn't hurt employment. Everyone is bracing for, maybe a soft jobs number in May and again in June. So these are the April and May payroll reports.
Right.
And no sign of weakness, right? We're averaging 300,000 jobs a month. We've created about 1.5 million jobs at least this year to date.
After 5 million last year, right? All-time record.
Yeah.
So
And look, the average year, over the last decade, the average year in terms of number of jobs created was about 2.2 million to be exact. So we're already there. We're not far away from that, right? So, and it's not often employment just falls off a cliff, right? The only time it fell off a cliff was the pandemic, right? But other than that, things don't fall. The economy doesn't fall off a cliff, and that was mainly why I think we can avoid a recession. And markets suss that out, I think. Look at the rally as well.
Absolutely. And one of our friends at Bespoke have pointed out it's 14 months in a row now that the jobs numbers come in better than what the economists expected, all-time record. That really, I think, hammers home the lowered expectations across the board, but the upside, it doesn't have to be wildly upside, but when you have lowered expectations, any good news. So, Sonu, I mean, I love this discussion. You and I could probably talk an hour on this. We need to make sure we don't, but, let's talk about hard versus soft data, because I think it's such a fascinating concept, right? Soft data is like the surveys, your PMIs, your ISMs on manufacturing, asking purchasing managers, hey, what do you think? What do you feel? Versus the hard data, things like durable goods and industrial production, the real stuff that's happening. I've done this for over 20 years now. I've never seen a time where you have such a discrepancy between the two. Do you want to build on that a little bit?
I think that, as you expect with soft data, sentiment has been weak, right? I think a couple of podcasts ago, we talked about it's like we have this negative muscle memory, all of us, because of COVID and inflation.
Right.
Things have just been, I don't want to say miserable, but it feels miserable in a sense. But then you ask people, how are you doing personally? And everyone's like, oh, I'm doing pretty well. I have a nice job.
Yeah.
Most people, fingers crossed, right? I completely recognize people who are struggling and all of that. But at an aggregate level, things are not too bad for everyone personally. But then when people look out, they're like, they see recession forecasts. And look, if I picked up the paper every morning, like every other morning, and if I saw some economists predicting a recession, I think I'd be pretty, I read all that stuff, by the way. But I think I'm looking at other data too. But I'd be a little down as well and say, if somebody asks me, how do you feel about the economy? I don't feel good about it. How do you feel about your own personal financial situation? Yeah, pretty good. Right. That's literally what we're seeing in the sentiment surveys. Same thing in the business sentiment surveys as well.
Exactly. And as we've said many times, the consumer makes up 2/3 of the economy. Consumers still quite healthy, strong jobs growth, wages growing more than inflation, some real positive things that are taking place there. You think about it, I believe housing makes up about 5% of GDP. Manufacturing makes up 12 or 13%, close enough for government work. So less than 20% out of those two. You could say those two were headwinds last year, I think would be safe to say. But now, we're seeing housing clearly bottom. You and I talked about that, I think, about 2 weeks ago on the podcast. Manufacturing showing signs it wants to. CapEx maybe is looking to bottom. All I'm getting at, to put a bow on this, what major headwinds last year, right? Housing, manufacturing, China lockdown, shutdown, all the supply chain issues, most aggressive Fed in 40-something years. All those things were headwinds, creating literally like one of the worst years ever for investors, with stocks down 20% and long-term treasuries down close to 30% and the ag down 10%. The good news, those things are becoming tailwinds now. Sonu, in like a minute or two, do you want to wrap up the economy? Then maybe we'll talk about the Fed and bonds next.
I think last year, what we were seeing and what we thought would happen is like the consumer makes up. It's sort of cliche to say the consumer makes up most of the economy. It does, but the consumer really held up the economy over the last 12 months, even longer, since the Fed really started hiking and getting aggressive. But right now, that headwind is shifting, and the Fed is close to being done. Housing is, 6 months ago, we wrote that some of those headwinds could become tailwinds. Right. The nice thing is 6 months later, fast forward to June 30th, let's say, or where we are today, those things are actually becoming tailwinds, right? Like if businesses are starting to invest more, that's great for short-term, GDP growth, but it's also good for long-term GDP growth because it improves productivity. Housing, supply chains is, builders are making new homes. That's great,
Mm-hmm.
right? Same thing. The automobile supply chain production has been improving too, and so that's a big deal as well. So a lot of these things. I mean, I think you have to really stretch to make a bear case for the economy, or let alone markets too, for that matter. I think.
Yeah, sadly, a lot of people don't have to stretch. They keep looking at the same things, leading economic indicators, the yield curve, things we've poked holes in for a while now. And I'll just wrap up the economic part. My daughter finally had the Taylor Swift concert. We've talked a lot about that. She had it in Cincinnati last weekend. Had a blast with my wife. They went on Saturday. I was there for 2 days, and I got pictures of it, and it was packed. And the economy continues to grow. Thanks to Taylor Swift going all over the country and all over the globe. She's going all over Europe this summer.
Amazing.
Next summer. My daughter's like, hey, let's go to Europe. Like, maybe not. But if she's in Ireland, she's in Ireland on.
She's America's stimulus export. Basically.
Yeah, she really is. She's in Ireland on like June 28th, 29th. That'd be kind of fun to go to Ireland. I've never been to Ireland before. I always wanted to go. I don't know. So we'll see. But my daughter doesn't listen to this podcast. No one in my family listens. I can say whatever I want about my family. They have no idea what I say on this podcast. So I can say whatever. But I have been thinking about maybe go to Ireland. That'd be kind of neat. I know James.
I think she's doing a concert in Argentina. The exchange rate may work.
Yeah, those are wildly cheaper. Anyway, but okay, so great discussion there. So the kind of 2.0 to this is the idea of interest rates, the Fed, and bonds. Let's kind of mix this together for the next 5 or 6 minutes here. Sonu, do you think we've said before the inflation's come back significantly? You've done amazing work here showing that. The shelter makes up a huge part of inflation, as we've talked about many times on this podcast. We see a lot of the inflation data coming lower when you look at the private places like apartment lists and Zillow. So we think there's still more. So inflation was over 9% this time a year ago. Now it's 5%. That's headline CPI. Different ways to look at it.
4%.
Yeah. 4%, down 5. You're right, down 5. I meant to say down 5, so down to 4%. Some parts sticks. Core PCE, we talked about that last week. That's the Fed's favorite measure, maybe a tad sticky. But overall, do you think if we continue to see improvements in shelter, the Fed, they shouldn't have to hike anymore, right? I don't think they should have to hike, but they do. What's your take on the Fed here?
Look, the Fed came out. I think everyone is going into this year, and we wrote about this, right? Connecting this back to the outlook. We wrote about the big question last year is how high will they raise rates, right?
Yeah.
As we saw it coming at the beginning of the year, we thought, you know what, the question is going to be how long will they keep rates high? Now, here we are in June. The Fed's still saying maybe 2 more rate hikes. I think markets are pricing in 1 more rate hikes. So Treasury yields yields are all going up across the board. I mean, best place to look is mortgage rates are about 6.8%, right? By the way, people are still buying homes at that rate. So, to give you some perspective of what's happening on that front. But yeah, I think with the Fed, one way or the other, look, they've raised rates to 5%, 5.25%, right? If they raise another 25.25%, another 0.5%, will it make a huge difference? I don't think so. I think that, maybe, I think both you and I think they'll raise rates maybe 0.25%. But if they go 0.5%, so what, right? I mean, I'd be worried if they're going to take rates from 5 to 7 or 8%. Now, I think that would be a problem. That would be a headwind. But there's no reason to do that because, as you just pointed out, inflation's come down, right? Inflation's come down on the back of food and especially energy prices, right? Energy prices have come down. Gas prices have come down. Utility bills have come down because of natural gas prices crashing, right? So that's been a tailwind for household wallets, basically. Now, the Fed focuses on core inflation. That's still elevated, but a big part of that is shelter. We think rental inflation is going to go down. We're seeing that in the private data. Official data is going to, show that by the end of this year. So yeah, there's no more reason to raise rates much further from here, right? So the next question is, okay, how long will they keep rates high? You and I think we're on the same page here with respect to, you're going to keep rates high for a long time, but a long time could be 6 months to 8 months. And now I think we get into a very interesting place come, spring 2024, but maybe we'll save that for our 2024 outlook, right?
Yeah, it is an election year. We'll just leave it at that. So there could be some drama when you come to an election year. Remember in March we talked about on this very
Right.
podcast that there was widely considered the Fed was going to start cutting, right? And we said,
Right.
we're not so
Yes.
sure about that. We didn't
No.
buy that then. We said it on this very podcast. Bonds
Yes.
had a good run, and then rates have gone higher, and it's hurt bonds a little bit lately. But I think with higher for longer is that phrase you hear on TV, meaning the Fed will leave rates likely at 5.25 here for a while, maybe 5.5 if they hike one more time. Potentially putting a little bit of a cap on bonds. We came into this year saying bonds would gain between 4 to 5%. We're pretty comfortable saying that could still be the case. Bonds have take a little hit here lately as yields have moved higher, but we still think you could make between 4 to 5% when all is said and done on bonds. Again, underweight bonds relative to stocks, so be very clear there. Anything else you want to talk about on bonds where you should maybe let's go this route? If someone wanted to invest in fixed income, where do you think they should put their hard-earned money for the next 6 to 9 months or so, or I guess next 6 months? We'll say the rest of the year, I guess.
I will give. I don't know how compliant, so I don't want them frowning at me for just giving out advice. But we'll just talk about what we're doing in our portfolios, right? We are underweight what we call duration, but for everyone listening, that just means we are underweight things like 10-year, 30-year Treasury bonds, right? Instead of that, we think, you know what, we're getting 5.25% on short-term bonds, so the risk reward there is much better. So let's just stay in there for now. Maybe later this year, maybe we may go back and we'll buy some more, 7, 10, 30-year bonds. But right now, we're not quite there yet, which is not to say we don't have any in our portfolio. We do have those kind of bonds in the portfolio.
Sure.
We just don't, we are underweight them than we normally would be, right? Because we think, as I said, the risk reward in our mind favors really ultra short-term cash-like holdings, where you could get 5.25 or something.
Yeah. No, absolutely, and that's worked well, so far this year. I mean, it is what it is. I mean, stocks have done obviously much better than bonds, so being overweight made sense. Then shortening your duration a little bit with, literally as the time you and I record this, 10-year yield is flirting with new highs on the year, or flirting with some new highs at least. So that's putting a little bit of a pressure on bonds there. So Sonu, great discussion there again. We still don't see a recession in the second half of this year, led by a strong consumer and tailwinds for manufacturing and housing. We still think stocks do pretty well, led by the United States, potentially making new highs in all likelihood, broadening out small caps, industrials, cyclical value, some of the areas we think can do, or cyclicals in general, I should say, could do fairly well as the baton is passed from technology in general. Then again, we just talked about bonds with rates staying a little higher. The Fed likely done, but they're not cutting anytime soon. And again, maybe bonds can get you 4 to 5% when all was said and done. What are some? Let's finish things up though with potential worries, things that could upset the apple cart. What do you? I'll go maybe first here. I mean,
maybe you go first.
Some of mine are almost cliche because you hear about them on TV, but I think it's real. I mean, U.S.-China relations are about as poor as they've been in a while. We're hearing semiconductor back and forth. I mean, that's not something that makes you warm and fuzzy, right? I mean, that the two superpowers should something. I mean, believe me, as a child of the 80s, I remember the superpowers, right? Randy Macho Man and Hulk Hogan, okay? It was great when they were friends. And when that spiraled out of control, that changed my life. It was devastating. So this isn't funny if U.S. and China did that. But what I'm getting at is, that could be an issue when two superpowers don't like each other. I don't say we like each other. You know what I'm getting at? If there is really some problems there. The other one is the Fed. I mean, it is what it is. I don't know why the Fed thinks they have to keep hiking. I'm looking at data. It looks like they don't need to. The Fed was wildly wrong for the longest time saying transitory. Say, we don't need to hike. Don't need to hike. You got guys like Professor Jeremy Siegel, friend of the podcast, still the most downloaded podcast we've ever done on Facts versus Feeling. He's saying you should be hiking. You should be hiking. They didn't listen. So the Fed isn't infallible. The Fed's not perfect. They have more data than all of us, but I don't know if they're trying. They got more PhDs than we do. We've got one. We've got you, Sonu. That's I think that's all we need, to be honest. But the bottom line there is I don't think they need to keep hiking, but they seem like they want to. They're still talking fairly hawkishly. Market seems to be buying that. So that's one that kind of gets me. And then valuations, it is what it is. Valuations are stretched, right? They are a little higher historically. We talked about that last week. Not wildly high. Right? Yeah, if you include tech out and things are a lot more manageable. Nonetheless, things were cheap coming into this year because nobody wanted to touch stocks. Everybody wanted their 5% in the money market, and they just wanted to get out of there. Well, look what happened. Stocks literally had one of the best starts to a year ever, and that's kind of how markets work, as we've talked about with sentiment before. But those are some things that get me. And again, the final thing, they call it a black swan for a reason. Maybe something happens that literally none of us are talking about, but I'll tell you what, I wouldn't lose it too much sleep over black swans. There's been a lot of money that have been lost on people worrying worrying about the big black swan that's out there versus just following what their advisor tells them, following their investment plan for long-term creation of wealth. And I just stress that. But still, there can always be a black swan that could upset things. What are some of the things? Hope I didn't take yours, but what are some things you think that could mess things up a little?
I'll connect both of them. It's sort of, gets a similar idea. I mean, it's been a cliche literally over last decade, right? Say, geopolitical risk. But it's been very salient recently because you had the Russia-Ukraine thing. And, usually, yes, there's a war that's, I think we in America are lucky, separated by 2 oceans from everywhere else except Canada and Mexico, I suppose. But, the war is there, right? It doesn't impact us directly in any form. But this time, there was an impact through inflation. And because of that, we got the most aggressive Federal Reserve in 40 years, right? Yes, this is not to deny the loss of life and all of that, right? So, definitely a huge tragedy in that regard. But with respect to how it impacted us in markets, and since that's what we're talking about in the economy, inflation, right? We've seen with the pandemic that disruptions across the world can create massive dislocations here in America, and that translates to higher prices, translates to higher Fed. So that's what is sort of concerning. I think in some sense it was always a concern, but it never happened, right? Until the pandemic hit. Boom, we got like 9% inflation. Now, I love something what you said, which is that folks, there's always a black swan somewhere, but you don't want to keep investing thinking about that. And that gets to something, we talked about, we upgraded our forecast 21 to 25% for stocks this year, right? Now, I would think the harder call was actually at the beginning of the year when everyone is mostly saying, oh, maybe this year will be -2. Most strategists saying this will be a negative year. And we were at 12 to 15%. The market's already up 17% as of the end of June. And so 21 to 25 honestly doesn't sound like a big stretch, more so given your amazing work. So, but the other side of it, getting to geopolitical risk, black swans, is one thing we do over here when we think about Carson house views, things like that. We have to ground it in something, right? A lot of it is grounded in historical evidence. Historical evidence, what does it show? At least in the US, stocks have done better than bonds. So by the nature of it, we always want to be overweight stocks. It really doesn't get much harder than that, right? So if you want to not overweight stocks, we want to be neutral or really bearish, underweight, we need really good reasons for that. And all this to say, right now, we don't see those reasons.
No. Well said there. So everyone, we really appreciate the leadership. Maybe I'm talking about you, Sonu. I appreciate your leadership. The listenership. The listenership was the word I was trying to say there. As we've done 42 episodes of Facts versus Feelings, it's been a lot of fun. We've had so much positive feedback. Obviously, we've had a good run. We really appreciate it. And hopefully you enjoyed this one, right? I know we've had a lot of I think people are realizing kind of what we've been saying for 6 months. I thought we were crazy 6 months ago. Maybe there's a method to the madness, and I'm seeing that and hearing that, and it's just so exciting to kind of build the investment research team and continue to help Carson Group in general build its brand and grow. And it's just such an excitement for me. My first year here, and this was your 4th year, right? You hit your 4-year annivery just a week or two ago. So
yes,
so that's pretty cool too.
I must say the last year has been the most fun, to be honest. So there we go.
Well, yeah, I joked when I started, the stock market went like straight down. We all remember it went straight down to October. It's like, oh my goodness, what a terrible time to start a new job as a chief market strategist. The market's getting annihilated, but fortunately, things have obviously turned around since then. So Sonu, this was a lot of fun. I've enjoyed working with you and obviously putting this mid-year outlook together. It takes a village. Joey Guidry's leadership, your help, obviously, I've chipped in as well. Our friends in marketing, communications, compliance, getting all the charts. Sonu and I love to create these silly charts, and we always want to change them. And we are aware it's a headache for everybody when we want to do that, but we're tortured artists. We always think it could be better. Maybe it can't be better, but we like to. So thank you for everyone who puts up with us every time we want to change something around. We know it's not easy, but it's taken a village to put this all together. Definitely, there's lots of different ways we'll be sharing on social media. Our mid-year outlook that you can read, you can look at. Our advisors are going to have videos they can share. We're going to have an official PowerPoint presentation they can share. We've got obviously this podcast, we've got different blogs, we're going to do some videos. There's going to be a lot of different ways that we're sharing this mid-year outlook with our partners, our advisors, and a lot of people in the public as well. So it's been fun. So everybody, thank you very much. We're going to sign off on the 42nd episode of Carson's Facts versus Feelings, and we'll be back next week. Who knows what we'll talk about next week? We'll worry about it when we get there. Hopefully it's more good news. But enjoy the mid-year outlook. Thanks. Yeah, go ahead, Sonu.
We have a very special guest next week.
Oh, I should know that. Yes, we do. Let's do a promo of that. Yeah, touche. Sorry, Meb.
Speaking of valuation, so definitely tune into that. It'll be an awesome, fun.
Well, you want to say who it is? You can say who it is. Go ahead and say who it is.
No, we have Meb Faber from Cambria. So been following his work for such a long time. Amazing work, both on the momentum trend space as well as valuation. So, definitely, as I said, tune in for that discussion. It'll be fun.
Yeah, we know that people like hearing Sonu and I, but they also like the guests we've had, and the fact we get Med Faber is awesome. We know advisors love him, and investors and people in general. He does amazing work, and he's going to be on our podcast next week. But in the meantime, enjoy the mid-year outlook. Check it out. Let us know what you think, and we'll just be back with Meb in 7 days. We'll see everybody then. Take care. Thank you. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.